if we talk about rents really quickly, a $300,000 rental price is very, very easy through some simple value adds, bit of luck, whatever it is, low vacancies, is very easy to get to, let's say, 360, so a 20% rental increase. That's quite simple because 360, most people can still afford 360. If you were to buy a house that's at, let's say, $800 a week of rent, to get a 20% increase on that, you've got to get to $960 a week in rent, which for the listeners that are living in Sydney might seem normal. But in a lot of these places, you're talking about infinity pools and maybe a car lift for the Ferrari and all the rest of it to get to those kind of numbers. It's a lot more challenging.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. I'm your host, Emil Pinder, and joining me today, got a very special guest. It's always a special guest, but this one is particularly special. This is our head of property. This is Sean Simpson, and Sean has been directly or indirectly responsible for pretty much every property purchase that Dashdot has made, at least in the last couple of years. So there's no better person really to let you know what is happening on the ground in terms of buying property. Strategy, we've got strategy teams, got all that sort of thing. But when it comes to you actually need to buy a property, this is the stuff to look for. This is what we're seeing on the ground. This really is, I wouldn't think there's anyone in Australia who has more reach across everything that's happening. So we're delighted to have you on, Sean. How's it going?
Yeah, really good. Great to be back. And it's funny to think about that. I've often thought about it. I've looked at probably 1,500 properties a week and every suburb in the country sporadically for every single 3 months for about 3 years now. So I've probably looked at a fair few. So I hope I'm well equipped to answer some questions.
And, there might be some big developers, your CBREs, and they might have looked at more individual properties. But, if that's just in one tower block somewhere with 400 in it or something like that, I would be very surprised if there's anyone in the entire country that has the range of expertise of having looked across so many different suburbs and everything like that. Now, the reason that we really wanted to have you on this podcast is because we're trying to solve a problem at the moment for people. And that problem is affordability. If anyone listening to this has listened to other episodes, you'll know that it's getting harder and harder and harder to save your way to wealth. And it's even getting harder and harder and harder to save your way into getting a deposit for a property so that you can invest your way into wealth. So that's kind of what we're going to be talking about today. What are the asset classes and what are the options that you have if that first rung on the ladder is starting to stretch out? And Goose and I were talking on the podcast about a month ago. And Goose is supposing that it's going to be really hard to get a house by beginning of next year, if you don't have $500,000 to throw at it, in a combination of your equity or your capital and your borrowing capacity, if you can't get up to $500,000, it's going to get really, really tight. So having said all of that, what have you got for us?
Yeah, so it's very interesting. And it's not just our clients, it's everyone out there that is struggling with this problem. And it's actually created some really unique patterns in the market that I've had the pleasure of watching. So yeah, we're in some pretty interesting times in terms of affordability. So what we're watching at the moment is, I don't even think it's just an option for people that can only reach to the bottom end of the ladder. It's probably the best option across the country right now. We're seeing a swing and a lot of demand start to enter into unit markets. So I know that might be a bit of a instant turn off for some people. They hear units and they go, oh, no, I can't believe it. But just to challenge that thinking, currently in Australia, there's about 47% of the total investment stock in the country is a detached house. So less than half of the nation's investments are detached homes. And right now, you'd actually be surprised to know that units are actually outpacing houses in terms of growth pretty well in all major centres across the country, in all major capitals, sorry. So yeah, there's a million reasons we could start to go into as to why that's happening. But I think it's a really, really exciting opportunity. It's what I'm doing at the moment. And it's going to be really great to share with everyone.
So you're doing this personally.
Yep.
All right. So if you're listening to this, the person who has looked at more property investment opportunities in the entire country than probably anybody else that you could ever talk to has said that he's personally buying units at the moment.
Yeah. Yep.
Okay. I did see some data that was shared a little while ago, and there seem to be large periods of time in Australia where houses are growing at a faster rate than units. And then there are swings, and those periods can last sort of like 6, 7, 8 years. And then there's sort of like a tipping point, and it swings back, and suddenly units are doing a whole lot better. Is there a story behind that? What's going on?
Yeah. So traditionally, the price disparity between houses and units will maintain a trend over a long enough period of time. So what I'm saying is the gap may widen, but it'll generally come back to a certain place. Right now, the gap between houses and units in all capitals across Australia is the largest it has ever been. So I was looking at some stats before. Over COVID, generally, this is the whole nation. This is more pronounced in different areas, but houses grew by 44%, where units overall grew by 22%. So they grew twice as fast across the nation. So yeah, what that caused is in 2021, there was a 9.6% gap between houses and units when you're talking the median of the whole nation, and we're up to 30% in 2023. So what's happened is that gap has got incredibly wide across pretty well the whole country, and that's exacerbated. That's just medians for the whole country. We've got certain areas we're looking at, which we purchased houses in, say in 2021, 2020, where units are now 100% cheaper than houses. You can have places where units may be 300 grand, where houses are 600, 650, 700. These are all affordable areas, and obviously we're taking the medians here, but there's some really, really golden opportunities there where they're primed for growth because the disparity is just so large.
Okay, that disparity is massive, and I guess that might, in fact, be one of the reasons. I've just had a little brainwave as to why the average price of a dwelling in Brisbane actually got higher than Melbourne, which you would think that's crazy, right? That's never really happened, and the reason was because the houses in Melbourne cost more than the houses in Brisbane. The units in Melbourne cost more than the units in Brisbane, but Melbourne has so many more units that kind of drags the average price down, whereas in Brisbane, you don't have as many. And so if you're looking at the average of all of the dwellings, Brisbane was actually slightly higher. So that's how much of an effect this is having. And I would suggest, or I would suspect, that it can't stay that way for very long.
No. So we've got so many ways we could take this, which is pushing it all in the same direction, which is up. But another interesting thing to think about is Australia currently, we can all agree that where demand goes, prices increase. And the demand for units is increasing for a myriad of reasons. But one of those reasons is not only is there a large price disparity, in many suburbs, the house markets have actually exceeded what we would generally take as a acceptable local relative affordability ratio. So what I mean by that is essentially how expensive is it for a standard local person that wants to live in that suburb to purchase a house. Once that gets beyond a certain ratio, doesn't mean nobody can buy houses in that area. And there's obviously people from outside of the area and people moving that can still afford it. But what it means is it generally gets a little bit trickier for the average person in the suburb to purchase a home. And when that starts getting pushed further and further and further, all it does is funnel more demand, more local demand, into more affordable asset types, which in this case is a unit which may still be sitting at prices half than that of a house.
Well, this sounds great in theory, but do we have some numbers where we can actually see this playing out?
Yeah, I could even get up some suburbs if you'd like. For those of you that are watching, we can go onto the suburb selection dashboard that we've built at Dashdot. All right, here we go. So I've just gone up into the outskirts of Townsville, which I know you might instantly think, I don't know about buying units in Townsville, but this is an excellent example of investor-led growth, which is where this is more pronounced than ever. So what investor-led growth can do in a suburb or across Australia currently, 30% of the listings are, or 30% of the total housing stock are rented, 70% are owner-occupied. So you can imagine the backbone of demand in an area is generally the owner-occupiers. What's happened over COVID is quite interesting. You get a lot of the investment demand for the country has been mobilised. Why this has happened is borderless investing, buyers agents, lots of other people have piled in, which have allowed people through tech and other ways to invest wherever they like. So what that's caused is a lot of growth in a lot of areas that wasn't led by the locals. But obviously what that does is that causes an opportunity where house prices can exceed or start to push past some of these local affordability indexes, which forces more of the locals into that sort of other asset class, which is what we've witnessed a little bit up here in Townsville. So, for example, here, I'm just having a look, and these are all medians. I'm just having a look at the general population stats in the suburbs. So you can see the median weekly household income here is $1,600. So that's about, what are we talking about, $80,000 a year. Now, when we jump over to house prices, so I'll just jump over to the key indicators tab. You can see that house prices have gone on an absolute tear. Now, median sales price here is 500,000. Median sales price is a lagging indicator. So a 3-month MSP, we'll call it, is 3 total months of sales. What's the middle? So you can imagine in markets that are moving week by week, it's a lagging indicator. So we know boots on the ground to buy a standard house in here, maybe 550, maybe more.
So can I ask you about that? When we say that's a lagging indicator, that means that we need to get the sales data once the property settles, which might be 6 weeks after the price has been agreed. And then the soonest we would be able to compile that data would be 6 weeks later, because we're trying to get a 3-month floating average so that we're not sort of, the numbers aren't pushed around by extremes. So realistically, the prices that we're seeing on any graph that's going to be reliable, the most recent data will be about 3 months old. And in markets that are moving as quickly as what most of these are.
Days, hours. Yeah.
It's, okay. So even though sort of we're as recent as we possibly can, we've got the most up-to-date data, it is still a lagging indicator. And so these trends that we're seeing are probably even more exacerbated now. So even though we're saying 500, 550 is probably more realistic because that data is 3 months old.
Yeah, so we have some little tricks that we use in terms of being able to identify that for our clients, like combining our predictive model with backwards-facing data to create a forward-facing indicator. We can do 1 month median sales price. Lots of little tricks I won't go into at the moment. But as for our client-facing dashboard here, we like to keep it very streamlined and simple. But yeah, what I'm illustrating here is that house prices have gone from 10-year average down in the close to 300, and I remember us purchasing some properties in here in the 2s, all the way up to into the mid-5s on a tear through COVID. So they've progressed significantly. Now, that's not saying that the house prices here aren't going to continue growing. I'm fairly confident they will, and the market heat in here is still extremely strong. But what we're trying to illustrate is that a lot of the locals in this area, and even other people, even national relative affordability still has the same effect, are getting pushed out of a market. So all that does is it steers demand into a different direction, into an asset that's still affordable. So going from that point at, let's say the mid-5s for a house, if I can steer properly, if I go over to unit data, you can see it's a fairly small sample set, which is why there's lots of choppiness here. You can see units are still at 285 in this suburb and haven't really progressed in the last 10 years or so. So they've stayed about the same.
You mentioned the affordability, and you mentioned that the income in this particular suburb, the median income was about $1,673 per month. How affordable is property there? Yeah,
so look, million indicators that go into what you can borrow. So this is not financial advice, but if I was to do super round numbers, if somebody had a household income of 80K and we were really favorable, like no car loans, no credit cards, no anything, you can generally get to about, depending your deposit, obviously as well, somewhere 320, 360, somewhere in that realm. You're definitely not getting to 550 on that at the current interest rates. All right, so based on the median income or median household income in the area being about 1,600 a week, which is about 80 grand a year. So I've just pulled up a very general Westpac calculator. So once again, this is not financial advice. We're just trying to give you a bit of an idea of what this looks like for a standard person that wants to live in the area. So let's just say place they want to live in that postcode. So let's go 80,000, not 600,000. We won't do that. And 20 for their partner, so that equals 80. That was the median income. So let's pretend they got no other income. Let's just go very basic living expenses and absolutely nothing else. No credit cards, car loans, nothing. So the broker's dream, we'll call it. All right, cool. And let's calculate. So there we go. So that's spat us out at $362,000. So they might be able to get to, in a first home buyer scenario, these are always very, very friendly because the bank wants you to apply through them. But even let's hold this to be true, they might be able to get to, let's say, 380.
380, that's best. That's someone with no credit cards, no car debt, none of that sort of thing, probably living at home. It's all of that stuff, right?
Yeah, perfect scenario.
Yeah, perfect scenario. Local person living in that suburb. can only really get to about 360, 380 absolute tops.
Yeah, 100%. And here's another good example of what I was talking about with the demand. So you can see here, of this suburb, we've got a bit uncharacterized here, but we've got only 39% of this suburb is investment properties, whereas there's 45% owner-occupier. So this is what we're talking about, the owner-occupied demand, which is based on the median of the locals that want to live there. Obviously, you don't have an owner-occupier from an interstate investor unless they're moving up there. So this is the bulk of the demand. Yes, this suburb has had a lot of investment demand that's been mobilised from other areas, but the bulk of the demand will still lie with the locals, which is the situation that we just showed a minute ago. Cool. So probably something else that'd be great to illustrate as well is a little bit more of our tech in regards to where units are headed. So let me just jump back over to houses. So what you're looking at here is a supply to demand ratio, or demand to supply ratio, or what we call the DSR. So we spent an awful lot of time back testing this. I'm fairly certain in the millions of times across every suburb in the country to develop this system. So the neutral band here, the grey band, is essentially when the ratio is within that band, prices are likely to stagnate. You can see here in the house market, things are absolutely going through the roof. There's quite a steep curve upwards, which would indicate prices are rising. However, as we just saw, the median sales price has enjoyed a whole lot of growth. So you can see as it's broken out of the neutral band here, prices have started to increase, which is why we entered the suburb. When you jump over to units, you'll see a very, very interesting pattern here where the demand to supply ratio is not only through the roof, it's also increasing at an increasing rate, which is always great to see. However, the sales price hasn't taken off yet. So that's what we like to call a Goldilocks zone, or an area where we feel is primed for growth, because all data is pointing upwards. There's a huge amount of demand entering the area, but prices haven't started to move yet.
Why haven't they? Is there a good reason why they haven't started to move yet?
Yeah, so a lot of the demand in this area was mobilized investment demand. So that's something interesting, where what happens there is that demand gets funneled, if they're going with a buyer's agent or something of the like, that demand gets funneled through the investment thesis of the buyer's agent, or if it's somebody doing it themselves through their own investment thesis. And this is why it's good to challenge our beliefs. We often say, strong beliefs held loosely. If you think of the general Australian investor, or even the general Australian buyer's agent, it's always, let's go, house, quarter acre dream. That's what's always performed. That's just the spiel that everyone's been told over the years. So it's very interesting to watch how that plays out in actual on-the-ground data, now that we're seeing a lot of this demand shift around the country.
I can understand why people have that preconceived bias, right? There's so much about land appreciates, the building depreciates, right? You buy the property, it's on some land, oh, here's your depreciation schedule kind of thing. Oh, yeah, the building's becoming worth less, but the property is becoming worth more. It must be the land. You can see like there might be an absolute heap of crap on a reasonable sized block somewhere near Bondi, and that sells for $3 million, right? And it's basically something that's about to fall down. So it's like, oh, okay, the land's important. Buy the land. That's what you're buying. You're not buying the property. Everyone kind of forgets the property's on top of it. But then when you have a look at an apartment building or a unit block, it feels like the land is a lot less. And therefore, kind of logically, a lot of people look at it and go, oh, well, I'm not getting enough land. I'm not getting enough of the stuff that's going to go up.
It's where it's a deeper layer of thinking. So this is why I love challenging people on this, because by that thesis that if I need land, I need the most land possible, maybe you should invest in a 500,000 hectare farm in Humpty Doo in Northern Territory somewhere, because that'll get you the most dirt possible for your money. But it's not necessarily how much land you get. It is the rate of appreciation per square metre that you get within that land. So the other contrasting side of that argument as well is, by that thesis that the most possible land will give you the best performance, maybe an apartment or a townhouse in Bondi or Central Sydney was a terrible investment 10 years ago. But I think we could all agree that that wasn't the case. So quite often with units, and again, there's different types of units. In a high-rise building where there's 80 apartments, you're only technically buying an 80th of the land, which is a very, very slim amount. But the thing to concentrate on here is, with units, you do get a portion of the land, and for the price that you pay, you will often get land in a more desirable area for the same amount of money. So what I mean by that is that the land will appreciate, although it's a smaller bit and you don't own the whole lot, it will appreciate at a faster dollar per square metre rate than something that you could afford for the same money further out where you own the whole asset. So, for example, let's go over to Western Australia. If you had $400,000 and you had the option to buy a villa, or one half of a duplex in the inner ring of Perth for $400,000, which is a likely scenario, you've got that within 5 minutes of the CBD, cracker spot, very desirable land. There's no more of that being built. For that same price in $400,000 in WA at the moment, you're jumping way out to some hole in the ground mine somewhere that's nowhere near absolutely anything. So yes, you may get more land out there, but will that appreciate at a faster rate or a slower rate? And it's arguable that it'll appreciate at a slower rate.
The other thing, just looking at Brisbane, Sydney, Melbourne, Perth, Adelaide, if you're looking for something for 400,000, can you even find that in the suburbs now?
Yeah, it's progressed further again. So that's a situation where it's not even an option for the general populace in these areas, which is why they do get squeezed either into these assets, because a lot of people have to live where they have to live if that's where their employment is, or that's where the exodus to affordable lifestyle happened, where a lot of people moved out of these areas. But again, I know that's a podcast topic for another time.
All right. So at the moment, from the way you've described it, it sounds like the main reason that the unit prices haven't gone through the roof in areas like this one that we've just looked at in Townsville is mostly because of preconceived biases. People have an inbuilt preference for detached dwellings because of the land content. And so normally houses go first. And after the houses have gone, once they start becoming unaffordable, that's when we see the big swing.
Anymore.
Yeah, when it's not really an option for people to buy, there'll still be growth in the housing market, presumably.
Oh, for sure. Not everyone is pushed out.
You're holding, right. So if you've bought, you've experienced some really nice growth, that growth will slow down. It'll still be there. But the unit market is, if you want to make 100 grand, 200 grand, 300 grand over the course of the next year, the best growth that you're going to find is going to be in these units. And depending on how many you're going to buy, then you can end up doing pretty well out of it.
Yeah, they're in a far better position. They're also really down when you're in an affordable bracket where your buyer pool or your demand center is so much larger. Like even in terms of rents, like if we talk about rents really quickly, a $300,000 rental price is very, very easy through some simple value adds, bit of luck, whatever it is, low vacancies, is very easy to get to, let's say 360, so a 20% rental increase. That's quite simple, because 360, most people can still afford 360. If you were to buy a house that's at, let's say $800 a week of rent, to get a 20% increase on that, you've got to get to $960 a week in rent, which for the listeners that are living in Sydney might seem normal. But in a lot of these places, you're talking about infinity pools and maybe a car lift for the Ferrari and all the rest of it to get to those kind of numbers. It's a lot more challenging. So that's why these units when you increase your demand pool, are very sensitive even to things like that. And that's one of the strategies that I use currently in my portfolio. Is I'll buy large full blocks of units, which the buyer pool for is very slim. The finance is a nightmare. It's a big old headache. You've got to have a load of cash to buy them. But then when you strata subdivide them or split them all off into individual ones, all of a sudden now I've entered the buyer pool of nearly the entire area for both rents and for purchasing these properties, because I've broken down what might be a couple of $1 million asset into 8 or 10, $250,000 or $300,000 assets.
Which people can buy and people can afford.
Which everyone, which is in the affordable index for virtually the whole centre and the whole country, So,
okay, it makes sense as a strategy. What other challenges do we have in buying units and things like that, and other biases that people have against them?
There's quite a few. There's probably endless. But something else that a lot of people always go on about is supply of units. There's infinite supply of units, which is where units as an umbrella term can be quite interesting. Units in a lot of data providers encompass everything. You can go from a penthouse to a townhouse to half a villa to everything you can dream of is a unit, where they all may perform differently in different areas. But supply is something a lot of people will hang their hat on. There's infinite supply. But if you're talking about, let's go back to the same example again, a half duplex in the inner ring of Perth that's on a reasonable little block of land, there is an infinite supply of that, because that land is already incredibly densely populated already, and there's not infinite land that you can do. Yes, if you're in the city, and they're building 80-story high-rises. Even that land isn't infinite, but there's infinite that they can go up. So that's probably one of the big ones. And another thing about the supply, even if we ignore that argument, is right now across Australia, I'm sure everyone's familiar, building and building approvals have had an absolute nightmare over COVID. The government did some incredibly silly things, caused a lot of dramas. There's an enormous labour shortage and material shortage for building across the country. So what that did is building approvals overall fell dramatically, but building approvals for what we call multi-res or multi-residential units essentially dropped by even more than single dwelling. That's caused by not only that labour shortage, material shortage, but also just a hell of a lot of red tape and fees that the government charge to be able to do these kind of developments. We've got a gentleman that works with us currently that added it up the other day. He bought a block. He wanted to just split it into two, put two dwellings on it, and the amount of money and headache, or the amount of money he had to spend on government fees as well as the headache to try and get this thing through, he gave up halfway through. So it's not easy at all to increase supply. And even if we just clicked our fingers, the government removed all the red tape, which we obviously have zero history of them ever decreasing red tape in anything. If we just clicked our fingers, all that went away, super easy to build, materials were cheap, there was excess labour, all the problems got solved. These kind of developments still take years from proposal through to getting actual to a tenantable state. A large development's about 4 years from when you'd propose something through to when it's tenants on the ground getting into it. So even if we fixed it all tomorrow, you're still talking years before that supply actually hits the market, which means units aren't just sitting in this little kind of sugar pump opportunity. They've actually got some really serious ground ahead of them over the medium term.
We did go through some of the numbers on another podcast episode fairly recently, and we talked about the number of building approvals, and the government has pledged that they're going to build, X number, whatever it was. And, 1 million homes, 1.2 million, whatever it was. And the building approvals are looking at sub 100,000. And that is incredibly low, like fewer than 100,000. Also for the units. Which I think is a pretty big problem. Now, the number of people that are coming into the country, a lot of people talked about 200,000, 400,000, 500,000 kind of thing, for a 12-month period that was measured, ended up being, and this was a recent 12 months, 737,000, which is like basically 750,000. And then you've got natural growth with more births than deaths at around about 100 to 110,000 per year. So you're looking at about 850,000 more people need somewhere to live. So at the same time that we've got the record increase in population and people needing somewhere to live, we've got a record decreases in building approvals year on year. It just keeps on going down and down and down. So now we're having fewer than 200,000 dwellings that are approved, but that's just the approvals. Then it takes 4 years to build the things. And so the government seems incapable of addressing the affordable housing problem.
Yeah, anyone that thinks the government is going to save the housing crisis in Australia is dreaming, to be honest. Luckily enough, I've left some stats up that I had open before, and private rentals across the country, so privately owned investment stock, in 2021 was 2.84 million dwellings. The government has 0.3 million dwellings, and they had 0.29 in 1976. So they've made no significant dent to improve that over the last, 40, 50 years. So, yeah, I would not count my chickens on them coming to save the day with a huge amount of government-led stock hitting the market.
Okay, so government's not going to be able to produce more stock. And at the same time, they're tying things up with red tape because why do they do that? Is it for fees? Is it to make sure?
It's an excellent question, to be honest. I'd love to know. If you find the answer, let me know.
Any idea?
Yeah,
any idea whatsoever of the motivation of the government? I mean, it's abundantly clear, right? People can't afford their mortgages or they can't afford property. A lot of people are getting locked out of the property market now. They're going to have to be renters for life unless they get into assets pretty quickly. It feels like units are a lifeline, right? Like that bottom rung of the ladder is just getting further and further, higher and higher, to the point where a lot of people can't get onto the bottom rung of the traditional property investment, go and buy a detached dwelling ladder. But we're sort of fortunate for a little while at least that there's another ladder where
There's a
you can.
lifeline out.
There's
Yeah.
an extra little rung there. There's an extra little rung that we can put on the bottom, which is called units. And it doesn't mean that you end up buying only units forever. It's just a great way to start because, honestly, people aren't going to be able to save their way to wealth. The speed at which property prices are increasing versus wages and how much people can actually save with the... Because it's not just, even if your wages go up by your salary, whatever, your income goes up by 10% over the course of a year, you might be thinking, oh, well, that's fantastic. But the cost of living has probably gone up by at least that over the same period of time. You're not actually able to save that much more. And in the meantime, property prices are going up by 30, 40,000 a month in some cases. So how on earth does anybody manage to get onto the property ladder? And if you get left behind, you could be looking down the barrel of never actually being able to invest in property.
Yeah, it's something I say a lot to my friends who are quite young right now. It's just that this may be the closest you ever are to owning real estate in Australia. So it's incredibly important that you reach out and you grab that lifeline. Not just that it's any old option and just jump on the ladder and that kind of thing. It is the opportunity over the short to medium term right now. So I think for a lot of people, like with what you were saying, with wages are growing, but like you said, so is cost of living, and they're definitely not growing in comparison to property prices. So there will be no closer time for a lot of people than right now to jump onto that ladder.
One thing that I've heard a lot of people say is, oh, well, all of this heat in the property market. Actually, I haven't heard a lot of people say it, to be fair. I've heard some people say it.
I'll wait for the crash, or...
Yeah, I'll wait for the crash. I've heard that a bit. What would possibly cause that crash? And the way I think about it is, well, how much does the government need money? The government needs people to keep on taking out loans, right?
Yeah. I love challenging that here is the crash all the time, and especially with units. A lot of people have made mistakes with units and off-the-plan units and lost money. But I heard a really interesting quote actually from one of the largest unit developers in Australia recently. He said something like, I've got the two best business partners anyone could ever want, the big banks and the government. And it made me think for a second that he's really right. Like, if you're going to place your bets on something going up, both the government and the big banks have enormous vested interest in making sure this thing continues to grow. A market collapse would be very surprising. So I think you'll be waiting a while.
The government can easily prevent the market collapse in the property market if they want to. In fact, in Australia, and this is something that I really admire about the the Aussie government compared to the American government, and that is, over in the States, they have non-recourse loans. Whereas in Australia, there are so many measures that we have in place that the government, and this is not the recent government, but over the course of the last 100 years, have put in place to prevent a property collapse like we saw in the States. And the amount of deposits that people need, the fact that the banks can keep on chasing you for the cash. There are so many mechanisms that are there to prevent a crash and to keep on propping the property market up and propping the property market up. Now, in the States, they have other assets that people can get into. So the property market isn't as strong as it is in Australia. When you look at the vast majority of the money that gets created in Australia goes straight into the property market, right? Because that's where the loans are created. And the banks and the government really need that. And I won't go into it in a lot of detail because I'm always talking about this on these podcasts. I'm always talking about monetary expansion. It's pushing the property market up. It can't go down. Where will the money go? All of that stuff, right? It's absolutely critical. And Goose and I did a recent podcast on it. We've talked about monetary expansion a lot and how it affects the property market. And it really does kind of bolster it and puts all the safety measures in place. So we can't see the property prices coming back. Affordability will slow it down. Maybe
depending where you go, not generally. So it's even in more bread and butter stuff. If we go like directly to the units, building prices have doubled, tripled, quadrupled in some areas. So lots of this existing stock that you're buying still at reasonable price, you're buying it like half replacement cost. So if you think with all this demand funneling into this asset and the fact that you're buying it at less than half it would cost to build a new one, and it is an absolute headache to try and build a new one, and you think it's going to go the other way, obviously, again, like prerequisite, we are very selective in where we pick to choose this type of asset and what type of asset. Please don't mistake this podcast for, hey, go and throw a dartboard and buy a unit somewhere, because units have inherently larger risks. There's a larger amount of DD that we do on these things from an asset perspective, from a strata, from body corp perspective, which we won't go into now. There's a huge amount of due diligence and focus has to be given to suburb selection, the asset, all the intricacies of units. So please don't mistake my words for go and pick a unit off realestate.com tomorrow and it's the sky's the limit. There has to be a very careful and concentrated approach to be able to select the right property in the right place in the right time, which I know we speak about quite a bit. But yeah, all these macroeconomic factors do still hold true.
Right. And essentially the key message there was units can be, there's a lot more that goes into purchasing a unit than purchasing a standalone dwelling. You get more growth, so there's more reward, but the due diligence, you really need to be on top of that to make sure you don't make a mistake, because things can go worse in units.
There's a lot larger risk.
Yeah, another thing I hear people talk about is they don't like units because there are management fees.
Yeah, it's an interesting
again. Yield and that sort of thing.
Yeah, you tend to find, like, I'm going to be very generic here, but you tend to find holding costs for a unit. Like, yes, you pay Body Corp, but Body Corp pays your building insurance. So a house in the same place, have to pay building insurance. You might not pay Body Corp. Yes, there's variations, and if you go and buy something off the plan that's got a lift and a 200 square meter gym and like all the bells and whistles, Body Corp is very expensive. But even with that example, I like challenging people where they say, no, I only want this. If I found a penthouse apartment that had the world's most expensive Body Corp fees, but I could prove that it was $400,000 under market value and a 20% yield, would you still buy it? And everyone would say yes, because the value proposition as a whole is still incredible. So you have to look at property investing from a principles and a values-based approach rather than a rules, because you'll end up missing a lot of gold by setting those sort of rules. So rather than focusing on, hey, there's Body Corp, it's what's the whole value proposition. Yes, maybe the cash flow is in a lot of cases better, but let's say in this individual asset, it might be worse. But if it's poised for growth, all the suburb indicates great data, the rent's set to rise, like all the rest of the value proposition is unreal. Like, do we really want to miss this perfect opportunity on the basis that you have $200 of extra fees a year? Like, are we looking at the right things in that value proposition?
Yeah. All right. Well, on that note, it might be a good time to wrap this up. Just to sort of summarize the picture that you sort of painted for me, and correct me if I've not got this 100% right. We do have a massive undersupply of property across the board in Australia, and because of that, we've really seen detached dwelling prices really shoot through the roof in a lot of places, and that's not going to change because the government just keeps on needing money. They keep on making lending criteria easier so that people can go and buy more properties. Very important for the government, very important for the banks, and great for property investors as well. But we're reaching a point now where those detached dwellings are becoming unaffordable for local populations, and we're at that sort of turning point where we're seeing a lot more growth potential in units, and even experienced more growth in units. We're at the point where units, because of that, are now growing faster than what detached dwellings are, and we've also got on this podcast a guest who has looked at more property than anybody else in Australia across a broader range of suburbs and asset types within property, who's now heavily investing in units himself. So that's pretty much it.
That's a pretty good summary. And yeah, I'd encourage people as well. It's often quite shocking. I send it to a lot of people when I tell people that units are actually outgrowing houses already. So I'd encourage people as well, just Google it. I saw an article from someone at CoreLogic recently, an article in some of the big news outlets. Like, this is already happening, but we just wanted to illustrate that they are poised at a really, really excellent point in the cycle. And for a number of reasons, supply is not looking to increase anytime soon, and there's a huge amount of demand being funneled into that asset for all the reasons that we've been through.
So it's not a case of, oh, look, I can't afford to get into a detached dwelling.
Yeah. It's not a second option. Yeah.
It's the first option. It happens to be a double whammy of it's more affordable and there's more growth potential based on all the data that we're collecting and all the numbers that we're crunching. So it's actually a better option in two ways.
Yeah, I've got rid of a couple of houses in a couple of locations, and I'm pending getting away with something. I'll have nearly 18 of these units in separate blocks or blocks in different areas over the next little while, because I'm so confident that this is the move over the next little while. So hand on heart, I'm doing it myself as well. This is not lip service. It is the opportunity that I believe in at the moment across the country.
Right. What I really like about that is that there are so many experts out there across Australia who say do this and do that and do this and do that, and they're great at telling you what to do, and they're not so good at the execution. You're sort of like, well, what does your portfolio look like? And they go, oh, yeah, I've got 3 detached dwellings. It's like, well, that doesn't give you a lot of confidence in units. But if you're talking to someone who's looked at all of those properties and now they're so heavily into units to the point where they're preferring them for growth over detached dwellings at the moment because of what we can see is going to happen in the market, then what better confidence builder would you need if you're thinking about getting into units? And the price points as well. Those price points, suddenly the property dream becomes a reality for a lot of people who may have written it off. May have been thinking, oh look, 500,000, my borrowing capacity is at 4. I'm done. I'm stuck. Now I'm going to sit on the sidelines and just be angry. Well, now you've got an option there. You've got an option that could actually. Like, how life-changing would that be if someone gets into we were looking at that suburb and the average unit price was in the high 2s, right? Let's say that they're able to get to 3. What could their life look like if that property goes up by 30% over the next 2 years, as we saw happen for so many detached dwellings 2 years ago, 18 months ago?
And maybe the strategy is different then. That's the thing. Strong beliefs held loosely, I think, so important. Like, I'll be honest as well. The first time when we started investing really heavily into data science and research in the unit market, I was thinking exactly what probably 90% of you out there were thinking. I was like, oh, here we go, like units. I was like, I don't like them. And for the start of my whole portfolio, I was detached only. I did like developments of the way to success, and I did little developments which we don't want to go into. That was a headache. But strategies move. Being strategy agnostic is so important to make sure that you can accelerate the rate of your growth while minimizing risk. It's so important, because what worked 5 years ago, what worked 3 months ago can change at the rate that the property market's moving right now. So yeah, strong beliefs held loosely is an excellent way to operate from an investment thesis point of view.
I was 100% the same before working at Dashdot. I was like, units. Someone talked to me about units. I'm like, oh, yeah, fuck off. Yep.
Yeah, I go, nah.
He doesn't understand.
Yeah.
He doesn't understand, right?
Yeah.
Whereas now, once you look at all of the data, it's like, I should really be shifting my portfolio around and getting a few more of these. I think that's
100%.
Yeah. All right. Well, thank you so much, Sean. It's been an awesome episode. If you're listening to this and you want to put any comments down, please make sure that you do. And we look forward to seeing you in the next episode. Thanks.
Thank you.